It's my great pleasure to welcome you to the Center for Global Finance Research Seminar today on an extremely interesting topic of subordinate financialization and distinct patterns of instrumentalizing the banking sector in Turkey and Hungary. And for this particular topic, issues and the important research behind the discussion today, we are delighted and fortunate to have three people with us, three top researchers with us. And let me take time to introduce them one by one. First, our very own Dr. Kerem Coban, who is a lecturer in public policy and management here in the School of Finance and Management at SOAS University of London. Kerem is a very prolific researcher and has also plays some important roles elsewhere apart from SOAS. He is an adjunct assistant professor and a network scholar in the Department of Political Science and Public Administration at Kadir Has University, and an associate member of an organization called LASGAP at the University of Lausanne. His other activities is assistant editor of the Australian Journal of Public Administration and also editorial assistant in social media of Policy and Society. He's actively researching a number of issues, including regulatory governance, with a focus on stability in policies or change in policies, institutions by examining the interaction between interest groups, executive, bureaucracy, and focusing on the regulation of the financial sector. And hence, the work today on banking, comparing Hungary and Turkey. He's published in the Journal of Financial Regulation, Policy and Society, Business and Politics, Review of International Political Economy, Policy. I could go on and on and on and on, but he's very contributing prolifically to the literature in particular fields. And the work presented here is ongoing work co-authored with Dr. Fulya Apaydin, who is from the Institute Barcelona de Estudios Internacional. I hope I did it very well. Very well known institution, IBEI, in Barcelona, in Spain. Holds a PhD from Brown University in the US in the area of political science. And she contributes very actively to mainly interdisciplinary to research using interdisciplinary frameworks, combining teachings of SPE, IPE, and economic sociology, and is indeed very actively exploring the political underpinnings of capitalist market building on the global south, paying attention to how local actors respond to international pressure. This is very exciting in general, but also very relevant to what is done here at SOAS University. And he's been funded by Brown University, Josephine Common Fellowship Trust, and in common with the Center for Global Finance, she's also been funded by the AXA Research Fund and the Spanish Ministry of Science and Competitiveness. Has authored prolifically, contributed to a number of books, monographs, and also actively published in the Review of International Political Economy, Economic Review, World Development. I could go on and go on and on. But we are delighted also to have the third co-author, Dr. Dora Piroska, who is from CEU in Vienna, as an assistant professor at the International Relations Department of the Central European University in Vienna, in Austria. Holds a PhD from the Central European University, same institution, in political science and IR track. And her research focuses on international political economy of banking and finance in the development finance arena, and has also contributed prolifically to a number of monographs Also, a number of journals, including the Review of International Political Economy, the Journal of Common Market Studies, New Political Economy. I could go on and on and on, but we want to acknowledge her expertise in the area of finance, especially with application to generating from political economy side of it. Okay, so we are delighted to have these three distinguished researchers today to share with us their ongoing research. In the spirit of the Center for Global Finance, I'd like very much to encourage all of us as a team to contribute to the discussion, raise contributions, make observations, so that Kerem, Dora, and Fulya also, benefit maximally from the fact that this work has been exposed to this forum. Please put your hands together and join me in welcoming Kerem, Dora, Fulya. I'm not sure whether they want to do it as a three-person drama or they're going to organize whoever wants to start can start. Please welcome Kerem, Dora, and Fulya. Thank you.
So you can see my screen.
Yes.
And
Perfect.
I'll be managing the slide. I leave the floor to Fulya then.
Okay, wonderful. Well, thank you very much for this wonderful introduction. My colleagues and I are most delighted to be here, and we look forward to your questions and feedback on this project. So this is basically a project that seeks to bring the IP and CP traditions together. We basically focus on two case studies, Turkey and Hungary. But why do we look at these two cases? So maybe you might have read in popular news outlets like Financial Times, The Economist, The Guardian, and so on and so forth, about how the leaders in these two countries are increasingly intervening in monetary policy, intervening in central banking decision-making. And we have seen in the last decade and a half these kinds of reports increasingly. One of the things that both leaders seem to be doing is focusing on credit allocation. And they both seek to exert greater pressure on how domestic credit is going to be allocated. And we basically observe an interesting pattern here. And we basically focus on how these two incumbents, these two leaders, instrumentalize the banking sector for their own political ends, to achieve their own political goals. You might be wondering why we are focusing on these two cases, why Hungary and Turkey. I think as different as they are in terms of their economic history, Hungary and Turkey share similarities in the sense that they have both experienced subordinate financialization under late neoliberalism. They're classified as upper middle income emerging capitalist economies. And because they are basically in the periphery or semi-periphery of Europe, and also of they're basically in the let's say in the periphery of the capitals of capital, they're exposed to market instabilities, especially global market instabilities, more frequently. And this imposes external constraints on their decision-making capacity. A second important component that we would like to focus on is how these external constraints also affect dominant social bloc preferences, meaning interest groups, including business associations, labor unions, civil society organizations, and other politically motivated organized groups that support the incumbent. How do they actually react to these changing market instabilities, and how does the incumbent position themselves in the face of the likes of 2008 crisis, for instance? Global financial crisis was critical, and it affected decision-making processes and political preferences and economic preferences of these actors as well. So the broader question that we have is basically an exploratory one, or starts out with an exploratory one. How does the executive in these emerging capitalist economies respond to these limitations imposed by their position and the global financial order, in the sense that they're basically constrained by subordinate financialization? So briefly, just to give you a quick snapshot of our argument, we argue in this paper that the two political leaders, both Erdogan and Orban, instrumentalized banking sector in distinct ways, yet with a shared purpose. They're primarily driven by political survival concerns. And this basically is a feature of the late neoliberal era that has resulted with unequal economic growth. The idea over here is to make a distinction between, for instance, the late developers, for instance, the likes of East Asian giants or tigers, so to speak. This kind of developmentalist logic that characterized maybe the development in South Korea or Taiwan or Singapore no longer applies to the countries that are constrained by the late neoliberal transformation. They cannot basically make long-term development planning, setting targets. Instead of prioritizing planned economic growth or economic development via high value-added production, they are more driven by achieving their political goals, which almost compels them to instrumentalize the banking sector for their own political ends, not for these big developmental goals. How does that actually play out in these two cases? What do we observe? In Hungary, the economic growth is primarily, the role of multinational corporations and foreign direct investment is very important in driving Hungarian economic development. But instead of going to banks, we observe that these firms rely more and more on inter-firm financing. So banks are not necessarily financing their funding needs. So at the same time, declining wages has become a concern, with this greater emphasis on propping up exports. To prop up for the loss of consumers, loss of purchasing power, Orban basically captured the banks and instrumentalized them, so to speak, to compensate for this loss of income by enabling easier access to credit for buying property or other consumer needs. And this also was basically unfolding in the aftermath of the 2008 global financial crisis and the EU enforced austerity measures. Now, in Turkey, banks play a more critical role in terms of driving economic growth. SMEs, also, even large enterprises still rely on banking and bank loans for financing their investments. So they really have a very critical importance in terms of making sure that growth effectively is on the positive end. Therefore, after the 2008 financial crisis, the priority was to ensure that these businesses with political ties, these especially politically connected firms, should have access to cheap funding opportunities that was no longer available in international markets. So the goal was to make sure that the incumbent secures their next electoral win by enabling this access to credit for firms. Now, you might say that, well, this is all nice and good. Banks have been always historically critical for capitalist development elsewhere. So what makes this type of instrumentalization so different? Yes, it is true that banks have really been critical. I mean, if we look at Arieti's earlier work, we see that they have been really important in driving the growth in Italian city-states, later under Dutch and British imperial orders. Early industrializers such as the UK and the US also relied on banks in driving industrialization and economic growth. Later in Germany, the state basically played a more important role in kind of coordinating the role of banks in driving industrialization and economic growth. Also in the post-war war, especially after the Second World War, we see kind of like a greater role of the state in coordinating growth by guiding the banks. In East Asia, as I mentioned earlier, developmentalist states such as South Korea and Singapore also guided corporate access to bank loans under an authoritarian rule. We know that. But what is really different under this late neoliberal era, or what we call neoliberal authoritarianism, is the following. It is very difficult for the countries like Turkey or Hungary that implemented neoliberal reforms, especially financial liberalization reforms early on, to kind of replicate this experience, this earlier experience. So under these circumstances, they are constrained by these international market instabilities to unroll planned long-term economic development programs. So that basically takes a back seat. Political survival becomes a more and more of a concern. And in this process, banks become tools for consolidating power for the incumbent to ensure loyalty and shoring up support, rewarding allies, or punishing dissent from the opposition. So this is effectively the key distinction that we see between what's happening today and what happened earlier under an authoritarian rule. South Korea was also an authoritarian rule, but it basically had a different logic that drove their economic growth. They basically were focused on achieving strategic economic goals, that there was greater intervention to hit targets. So banks were instrumentalized, sure, but for a different for a different economic purpose. And what we observe over here is the prioritization of these market-oriented policies for growth constrain the governments in Turkey and Hungary in different ways to prioritize political consolidation to shore up political support for staying at power. So it's more short-term, not long-term planning. It's all about short-term gains, political gains. It's all about electoral cycles and securing the next electoral win. At this point, I think I will pass the microphone over to my colleague, Kerem, to walk you through the Turkish case, and then Dora will take over for the Hungarian case. Thank you.
You can hear me, right?
Yes, yes.
Yeah, okay. Yeah, great. So
Thank
this
you.
is the
Thank you very much, Fulya. Yeah.
Yeah, this is the analytical framework in a nutshell. So then now I'll be taking you towards short-term capital flows arrow here, this path in the Turkish case. So in this paper we also like explore and also like demonstrate these trajectories of instrumentalization and its nature has also like transformed over time. So the Turkish story here begins with the local banking and economic crisis in 2000 and 2001. After which there were like a consolidation, a closure, then consolidation of the banking sector, because I mean there was a systemic banking crisis in the country. Many like small banks were like this failed, or like some were privatized through like opening up the market for like a further foreign acquisition. And there were also like mergers within the domestic sector. At the end of the day, we observe now, I mean, there are three public banks, eight domestically owned private banks. So the major shareholders are, I mean, so domestic the business or like and also 21 foreign owned banks. So in total, so there are also like development banks. So we are like currently like just focusing on retail and say the commercial banks. So as there are also development banks plus investment banks, I mean, which we do not like add it to the like the picture, but at least I mean, the banking sector is the backbone of the Turkey's capital inflow dependent credit-led growth model, as more than 90% of total assets in the whole financial sector are held in the banking sector. So, I mean, it is dominantly a bank-based, I mean, financial system, where I mean the banks provide the chunk of financing for the state plus private sector and households. So everyone like benefits like rely on this actor. So that's why I mean it's so like critical, so like important in this context. So at the same time, we also I mean observed de jure autonomy given to the central bank, which did not exist before the crisis. Second, there was the establishment of an de jure autonomous banking regulation supervision agency at that time, and this period between 2000 and 2013, in between, yes, we had GFC, but I will also like mention it. But capital inflows were like too high as the country was bouncing back from a severe, dramatic, historical banking and economic crisis, and the market was opened up for through like additional like privatization efforts. Foreign banks were also involved. State-owned enterprises were privatized. So there was like lots of like FDI coming in. Plus, I mean, at that time, international capital markets were also liquid until, I mean, at least like a global financial crisis. I mean, there's a once we like observed I mean, if a significant decline in the economic activity. Second, relatively say cheaper capital flowing, I mean, around the world was also a bit like a drained. But I mean, this was a bit like a short period of time, thanks to yeah, major central banks, which then they as they opted for to embark on loose monetary authority through, as we know, quantitative easing policies, which made foreign capital cheaper and cheaper. So as we see also, so economic growth was also a bit like high. So it like went down even like because of the GFC effect here. But I mean, it bounces back like relatively like very like shortly, and it was also even like the boom even compared to the like so this like period. I mean, it was like going down, but then it bounced back. And here, domestic credit to private sector, which was like mainly like given by the by banking sector, played this role as this credit allocation made such economic growth like very sort of very like sensitive to credit allocation. As this model, this credit-led growth model, which was mostly like a finance through capital inflows, then got a bit, let's say, like structural, even say institutionalized. And then the economy became more and more, say, capital inflow dependent and credit-led to drive and generate and to drive economic activities. Yet, I mean, so during this like a period even, so as I mean, capital inflows were so, I mean, like high capital markets at the international level were also, I mean, sort of washed with like a cheaper, like the money, especially after the global financial crisis. Here, the banking sector was an instrument to mediate between international markets where they were able to like borrow at like a cheaper rates and lend out in the domestic market relatively at a, I mean, like a higher rate. So because I mean that even if I mean interest rates went down even to like zero in the like capitals of capital, still I mean it was like higher as it was the lowest rate of the Turkish like, treasury bill that went down to just to like the 5% in May 2013 before the like the Fed announced its tapering. So it was like in terms of like such arbitrage, so banks were able to borrow cheaper in the international markets and then bring that foreign currency denominated that to the domestic market and transform it into Turkish lira and send and allocate credit especially to I mean finance business plus households and mortgages, which finance construction and therefore the housing market. But like here, I mean, even the like banking sector was instrumentalized by the central bank by through its what was called at that time in 2010s as unconventional instruments, monetary instruments, the reserve option mechanism, for example, which incentivized the banks to borrow cheaper at, I mean, in international markets and bring that foreign currency pocket as the in lieu of their Turkish lira reserves in the central bank, which helped the central bank to boost its reserves in nominal terms at least. So at the former deputy like governor like once like mentioned in another research also, so they actually left the reserve policy to the market, in other words, the banking sector, to find that, I mean, foreign currency flows that could be included and also parked in the central bank. So, which were, simply banks were getting these foreign loans from the international markets, transforming at the like these foreign currency loans at the central bank, and then into Turkish lira and lending it to the private sector plus households, which I mean like masked like especially the role of interest rates and also like which like provided like this like a booming economic growth at that time, which like secured like several electoral like cycles and like maintaining AKP's Erdogan's power during this period. But this has changed, especially after the taper tantrum, and like, which was like a sort of an I mean like a consequence of the like a global financial crisis at that time. So once a major central banks then decided that I mean there will be no more cheaper capital provided to the markets. Then I mean we have seen also a slowing down of like a capital inflows, which also like which like it meant that I mean external conditions worsened in terms of the cost of capital plus the available capital that I mean which could be like transferred like invested like brought in to the into the Turkish borders and the financial system, and as such, so if I mean, imagine, I mean, your economy like relies on capital inflows to finance domestic credit-led economic growth. But if you cannot receive enough capital, foreign savings, foreign investment to, I mean, boost or to just to like maintain like the like similar levels of economic activity, which relies too much on credit. So you need to find something in, I mean, just to, I mean, replace that like a foreign source, right? So which then like appeared as domestic resource mobilization, which simply meant that you have to create more and more Turkish lira loans without relying too much on capital inflows. I mean, because I mean there is also not much. And also, I mean, at that time, we have seen actors also have become more and more responsive and very sensitive to the interest rates, because higher and higher capital inflows coming into the country, I mean, meant that, I mean, Turkish lira was like overvalued. Second, they did not have to, I mean, really care about interest rates, because, I mean, like money was like everywhere, like cheap money was everywhere, interest rates were low. Everyone was like enjoying this sort of in this party. But once this money was like money like vanished, and then we have seen that, I mean, we need to just rely on interest rates either to attract capital inflow, but higher interest rates to attract capital inflows meant, for example, so yes, I mean, if you increase interest rates here, then it means that, so there's like a time lag. I mean, it became like more and more sensitive to the local interest rates, and capital can actually come in. I mean, in like one or two like the quarters. So there's a time lag, but it responds to higher interest rates. But attracting capital inflow with higher interest rates may means lower borrowing, lower investment, and therefore lower unemployment, lower employment, which then indirectly at the end of the day causes some popular unrest within the society. So imagine you are in this condition and you have to balance higher interest rates plus your coalition's interest, and you want to remain in power. So the nature of instrumentalization. So after 2013 changed with the rise in the salience of interest rates. For example, like business became more vocal. For example, I mean the bank regulator had imposed macroprudential regulations with restrictions on household consumption to reduce the pace in household indebtedness. And the business lobbied the bank regulator to lose banking regulatory standards. And also the executive also like started to engage in public polemics with the public officials. For example, even like Erdogan like accused of the then governor of the central bank engaging in a treason by keeping interest rates higher. So at the end of this governor like a term, he then replaced the governor with an ally of his son-in-law, for example. And in the meantime, because I mean, capital inflows were not that high, and then the country still like required like a credit. So the government also activated a credit guarantee fund, simply SMEs mostly, which I mean lacked a certain like quality or like amount of collateral to like a borrow from the banking sector. The treasury backs like a part of those credits. So it was like actually like it was a very old institution, and it was like in between 1994 to 2015. It was just around 100 billion liras, but it then like reached to 755 billion liras cumulatively by 2022. So, I mean, there was a huge amount of like credit distributed through this mechanism to the private sector, and SMEs were the main beneficiaries. So why do we focus on SMEs, for example? So they employ more than 50% of the like labor force in the private sector, and they also constitute one of the major actors like within the private sector that support the government. And here, so the banking sector was instrumentalized in a way to channel those credit guarantee funds triggered activated loans. Second, I mean the banks association also was also politicized and even captured. as the general like manager or the general manager of the largest public bank they began to like chair the like banks association. And another indicator, especially which then continued and then intensified, was the use of public banks. As the executive has direct control and influence over public banks, so it started to replace, and even the public banks started to occupy the majority of the market in terms of total assets. Now they also they can control like more than 40% of the total assets in the banking sector, which was actually, since the intention with the consolidation, also the restructuring of the early 2000s was to allow more like the market actors, like the foreign banks, even as you see, for example, the share of foreign banks and even the domestically private banks in terms of assets. Now they have been replaced, like dominated by, especially after 2017. We observe, the public banks are now like driving the whole the banking sector. So here there was also a verbal attacks on the foreign and like the private banks, just to like motivate or to like force them to allocate more and more, credit, as the then Minister of Finance and Finance and Treasury, son-in-law of Erdogan, for example, even like accused them of like sitting in like the plaza, like the nice, like the fancy plazas, and not even engaging in the banking as in like a practice, just to through this sort of verbal attacks and like making those like issues like more public, the politicized, the public salient, that private banks are not actually providing credit. And even the like business started to complain, even not being able to receive loans from the private banks, including the like the foreign banks. So as the banking sector became more salient, second interest rates became like the salient here. There were like several acts on the during this period, especially since the 2018, when the political regime changed, and Erdogan and his coalition also gathered this power to manage the whole apparatus now. So there was a reactive nationalist response, especially after the currency crisis in 2018, but interest rates were first, as in reactive sense, it was first spiked here to also like trigger some like capital inflows. But business plus Erdogan was not happy with that with that decision. So they sacked. So Erdogan sacked the governor, replaced with the deputy governor, who started to reduce interest rates. But then there was also another replacement, which continued with this. With the spell of slashing interest rates. And once the COVID crisis hit, we also see, this huge capital reversal, which then was like responded with some interest rate hikes. But at that time, even the Erdogan and the coalition did not like this position, and this governor was sacked as well. With a new, the governor who started again like slashing these like interest rates, and then we observed the like huge like, depreciation of Turkish lira in the latest period. At the same time, this reactive national response also meant that the London offshore market was closed, so banks were not then allowed to trade Turkish liras against foreign currency, because it was, interpreted as there was an attack from the like foreigners on Turkish lira in 2018. And then the COVID-19 crisis hit. in order to force banks to allocate more, just to revive economic activity, the regulator implemented this, this drastic measure of capital asset ratio, which required banks to either to allocate credit and or to purchase more, like say, government bills. Second, the central bank engaged with the treasury through some undisclosed MOUs, and they use public banks to transfer to intervene in the foreign currency market, which was undisclosed, but it is professional financiers and also economists revealed that like more than $120 billion were just like used to intervene in the foreign exchange market through public banks, thanks to this MOU between the Treasury and the central bank. And also, then we came to this, so latest spell of slashing interest rates to, before the elections. And we have seen, especially the worsening of, so the deepening of sovereign bank nexus by regulating the market to force banks to purchase more and more government bills, to spend more of their assets on the government treasury bonds and bills, which then increases the bank sovereign nexus. So through those stricter and frequent and sometimes incoherent regulations, we have observed that the banks were almost instrumentalized for resource mobilization, not to channel those cheaper loans to the SMEs business, the main private sector supporters of the regime, and that they were and this instrumentalization meant the subordination of the market market dynamics and these actors. So I leave to Dora for the Hungarian case.
Yes, thank you, Kerem. Can you hear me?
Yeah.
Great, thank you. I'm going to continue with an overview of the same or similar time period for Hungary. I'm going to start with the end of socialism and the beginning of capitalism, simply to give you an idea about how Hungary integrated into global financial structures. And by the time Orban came to power, how Hungary has essentially been positioned in a subordinate way in global financial markets. So basically, after the opening of 1990s and transition from socialism to capitalism, the banking sector was essentially restructured following a strict neoliberal logic. After an initial hesitation, in 1995, a major decision was made, and 80% of the banking sector's total asset was privatized for foreign owners, particularly for investors from Western Europe, Austria, Italy, Germany, France, and to some and with one bank, the United States, also acquired assets in the Hungarian banking sectors. Initially, these banks came as they followed their clients, the multinational corporations, which were also at the same time investing heavily and restructuring the Hungarian economy. So the 1990s saw foreign bank ownership primarily serving multinational corporations' financial needs. However, after the early 2000s, with the global restructuring of banking as it moved from bank-based to market-based finance, we saw a similar restructuring, but following a bit different logic in Hungary, in a sense that the banks withdrew from financing multinational corporations. MNCs primarily started financing their own investment through intra-firm financial channels. And so the foreign banks looked for an alternative market, and that was obviously households and small and medium-sized enterprises. Now, small and medium-sized enterprises are very important for the Hungarian economy, but not for growth. They're important for employment. They provide, just like in Turkey, at least 50% of labor market, or even more, I would say. But growth, in an FDI-led growth model, it really depends on MNCs. So when the banks decoupled from the FDI-led growth model, it was still very influential politically because it was financing a large segment of the labor market and a large segment of households. So in the early 2000s, when there were cheap credit on international financial markets, the foreign banks saw a lucrative business model in providing foreign exchange denominated loans to Hungarian households and SMEs, which obviously carried huge risk due to the nature of FX lending, which was not realized until the 2008 financial crisis hit. So the banks in this new business model in the early 2000s realized formidable gains on the Hungarian market. But the 2008 financial crisis hit Hungary. It hit through three channels. One was a public debt channel. The Hungarian government was facing a public debt crisis because it was unable to finance its public debt obligations due to the drying up of liquidity on global financial markets. There was also a currency crisis because most of the banks that were facing also problems in financing their long-term obligations to the Hungarian market by short-term takes from international markets, again, due to the drying up of the liquidity on global financial markets, couldn't satisfy these demands. We're all needing finance in FX, and that's the Hungarian central bank could not provide, right? They can print money, but only Hungarian forint, and that was not what was needed by the Hungarian banking sector. So the Hungarian financial crisis in 2008 was a currency crisis, a public debt crisis, and a banking crisis that needed the intervention of IMF, the European Central Bank, and the European Commission, which basically was resolved through massive austerity measures targeting the Hungarian society and the non-foreign owned banks. Kerem, could you please go to the next slide? I would like to show you this slide because I think it shows very nicely this decoupling of bank lending and GDP growth. So as you can see, after the 2008-2009 financial crisis, the story I'm going to tell you now, the Orban government massively intervened in banking and reduced bank lending to the overall. So where the banking market is in households and SMEs. Nevertheless, GDP kept growing primarily because GDP is driven by FDI and multinational corporations in Hungary. Kerem, please, next slide. Thank you. So the story from 2010 to the COVID crisis is basically a neoliberal authoritarian restructuring in Hungary. The previous neoliberal conditions, I argue, paved the way for Orban authoritarian take in power because of the nature of neoliberalism encapsulating capital owners and capital and the management of finance in this case from democratic oversight. And this structure was very helpful for Orban to intervene into banking. Initially, in this time period, there was a need for managing the crisis, and Orban used such measures which were incompatible with the rule of law and with democratic oversight, with transparency, but were very effective in managing the crisis, especially for middle-class household with FX loans and SMEs with FX loans, and was quite harsh on the bank's profit margins. There was a massive tax on the banks, and the banks were forced by law retrospectively to swap their FX loans to Hungarian foreign loans. At the same time, the Orban also managed to reduce public debt and manage the public debt crisis. But in the same way, IMF and EC and the European Commission were verbally attacked as agents who are interfering into the Hungarian economy. The central bank until 2013 was managed by an opposition leader, but after 2013, an Orban ally was nominated to be the governor of the central bank, which then redefined central bank independence. It basically used this as an opportunity to shield it from civil society and opposition interference into central banking, and was a major ally of the government. The central bank also, interestingly, within this newly found policy room that are not constrained anymore as much of neoliberal considerations as the previous regime was, underwent a formidable mission creep in terms of providing development loans for small and medium-sized enterprises. So the central bank took on practically the role of a development bank. But it also became a bank supervisor. It also became a consumer protector agency. It bought the Hungarian Stock Exchange. So now the stock exchange belongs to the central bank. The central bank founded a university. It created a huge foundation for government and international international security purchases. So I mean, it's just a long list of what the central bank was doing, and some of it as a way of, if I may, put some sarcasm into my presentation. Our governor is not. It's not the most ordinary central banker. He doesn't believe. He believes in number mystery. So the number 8 is not allowed to be painted on the floor in front of the central bank where the cars are parking. He divorced his wife and married a yoga instructor. And since then, we listen increasingly in the Hungarian public discussions on the influence of mysticism on central bank policies and the logic of the Hungarian language as a source of growth. So I don't really want to go more, but this is a formidable change, which is, I argue, allowed only within this authoritarian context, would not probably go or fly in a democratic setting. All right. The COVID crisis is the first one which brings an important policy direction change. And that is because the COVID crisis is reducing the government spending room. There is a growing budget deficit, a growing public deficit with the highest inflation rate within the European Union. Hungary stays obviously outside the Eurozone. It manages everything in Hungarian forint. And so after the COVID crisis, a full-scale banking repression and instrumentalization unfolds, with Orban and his business allies and cronies founding the second largest Hungarian bank. It's now under their control. The government continues providing subsidies for loans to SMEs and households through the banking sector. Foreign ownership reduced to 50%, but the foreign banks are also becoming an ally of the Orban government, as the new policies, the subsidized loans, are fantastic opportunity for them to realize profit. So why not, right? Even if it's not market driven, it's authoritarian driven, as long as the foreign banks see business opportunity, they comply. They also comply in the government regulatory measures, just like in Turkey, which forces them to buy government bonds. Again, it is still a lucrative business for the banks. So if you think about it, the banks, both asset side and and liability sides are restructured by government regulatory measures. So we are going a little bit back to monobanking in Hungary, when the government was setting the interest rate or setting the target of who would be receiving loans. These are primarily well-selected businesses from within the domestic market, as well as the social bloc of Orban, middle-class households and SMEs, who then serve all kinds of political favors for Orban within an increasingly restricted democratic economy or democratic labor market. All right, I think I'm done. And I give you back the word for the conclusion.
So maybe I can just jump in and then summarize the project. So as we have seen, both countries have implemented neoliberal policy reforms around the same time, but their mode of aggregation into global financial markets and global markets was rather different. I mean, in Hungary, we have seen that growth is primarily driven by foreign direct investment, and MNCs play a very critical role. Whereas in Turkey, growth depends on very much depends on short-term capital inflow. So when a crisis hits, and in the aftermath, we have seen multiple volatilities since 2008. It's not just one critical juncture, but multiple instabilities. The response of these two countries basically varied. In Hungary, in both cases, incumbents are driven with the motivation to survive politically, but they don't have these big developmentalist agendas. But in Hungary, banks were instrumentalized primarily for partisan access, also especially households for consumption. SMEs were also critical, but this partisan voters and rebuilding of the social bloc that supports the incumbent was a primary worry for the Orban government. Whereas in Turkey, banks, we have seen they were instrumentalized for partisan business access to credit. So banks play still a very influential role, but this was effectively to serve the needs of an even narrower social bloc that supports the incumbent, that is critically important from a political survival perspective. So, and in both cases, we basically see this unfolding under a neoliberal authoritarian setting. And in both cases, these political objectives basically took the front seat as opposed to long-term developmentalist agendas. So I think I should stop at this point, and we should probably open the floor to questions. Thank you so much.
Oh, thank you so much. Let's give a hand of applause to Dora and Fulya and Kerem for such an interesting paper. This is very fundamental research. And all the way, I enjoyed every aspect of it. I started by flagging up the fact that Turkey and Hungary are frontier emerging markets on the periphery of the EU. They do have a very important role, not only within the region, but also as global economies. And there's something fundamental in this type of work. And I'm sure the work could be extended to look at some other economies, the structure of some other banks in some other markets. So it lays down, it puts down the marker for what we should be looking at. And maybe one could argue that banking, the role of banks has changed since the 15th century and since the 16th century. But from the way who owns the banks, the role of the banks in terms of especially providing loans and debt, the role of banks in some economies in trying to restructure companies, and of course also the political systems have changed. So what I find very fundamental is the key argument of the instrumentalization of banks for political consolidation. Okay, this actually is a project way beyond the two economies. And I think you are provoking researchers and policymakers to look into these arguments of instrumentalization of the banking sector for political consolidation, way beyond the typical business operations of the banking sector. It's an important dimension considering that the fact that what we see from what you have presented on Hungary and Turkey gives some complementarity with what we have seen in the literature. For example, the role of banks for international trade. Here, for example, the case of Japan. Japan expansion with the IBEI, International Bank of Japan, was to support international trade. That was the main driver. And then you see the roles in Germany with the banking sector owning companies, which is unique, different from the UK and the US. And that's just to promote actually industry and private sector to grow. So I think you are providing a very important variation from what we know in the banking literature and bring in the political economy side. I like that very much. One aspect I was thinking though, and looking at this is maybe a little bit of some details, and to borrow the usual expression of Yusuf Somare, who is in the audience, says that the angel is in the details. He doesn't say the devil is in the details. The angel is in the details. You provide very good details about, you distinguish between domestic banks and foreign banks. The study also distinguishes between private banks and public banks. What is not clear to me, and whether you have the data available, is whether the type of banks does matter. If you distinguish between, say, central banks on one hand, okay, different, and you have explained that very well, distinguish between commercial banks, development banks, wholesale banks, like the investment banks, they do say, operate wholesale. So do these observations of the paper still apply to all banks, irrespective of the type of bank, development, commercial, investment, and of different sizes? Okay, because it may well be the case that the government can capture domestic banks, but is it also capturing all the commercial banks? It has got, the development banks, the wholesale banks, if there are any, and also drawing a parallel to the supporting role of banks and the capital market. Maybe there is a very intimate relationship between banks and capital markets. There is like a stock exchange, capital market, and whether this plays an important role. Now, I must confess, I haven't looked in detail at the banking sector of Turkey and Hungary, but I know for most banks in the world, some specific data exists which may throw some light, like in one of those tables. For example, I'm aware that standard bank balance sheet data in the balance sheet of the bank exists. For example, the standard balance sheet is deposits on the financing side. So those are liabilities. D plus E, deposits plus equity, then is channeled into either loans or securities. So banks channel their resources into loans or securities. You can also disaggregate the loans into loans to public sector companies, that is those if they are owned by government, some companies owned by government, and loans to private sector companies. You had in the figure, very good figure on loans to a private sector, but I'm not sure whether you have loans also to government-owned companies. But the other component of the use of funds, I think is the most interesting. I think that there was mention of the fact that a part of the capture of banks is that banks do purchase government securities like treasury bills. Okay, so the other interesting aspect is to see whether there could be data of the evolution over time of how the bank has been active in buying government paper like treasury bonds or treasury bills or government bonds compared to lending the private sector, whether actually the part of the capture of the capture of the banking sector involves crowding out the private sector and therefore involves disintermediation, where banks, instead of intermediating resources from the deficit from the surplus deficit unit, is rather channeling the resources to finance a government debt. And there are many good reasons why banks do that sometimes, even without political capture. It's, government debt is sometimes safer, to do that compared to loans that are paid on about 70%. And so there might be some, but I think maybe that if the data is available on those, maybe, again, that could be very much consolidating these arguments and maybe generating something. There's something else, third point, something else I was thinking about, provoked by your presentation, which went very well. The other point was how Hungary and Turkey, how quickly or not quickly they signed up to Basel III. The reason is the transition from Basel I, the 80s, to Basel II was rapid for most countries. But even when they signed up to Basel II, they still operated on Basel I, the capital adequacy ratio of 8%. They never really integrated. Some central banks never really, some banks never really went into Basel II. And then the global financial crisis hit. And then all the world moved to Basel III. Some countries signed up to Basel III. They have never actually implemented Basel III in principle to look at the market dynamics, to put in the market risk. Now, I'm not sure where these two countries are. Are they still on? I know for many countries in Africa and Asia, they are still at the crossroads. Still, they look back to Basel II. We like Basel II, but they get the show we want to Basel III, and they are still there. And the whole world is calling for Basel IV. So the reason why that might be important is maybe the migration to Basel III may have made a instrumentalization of banks for political consolidation extremely difficult. It would. Of course, they can sign up to paper and still ignore they are signing up to that, which would be a different a different configuration. But I'm very excited by this work, and I guess many people in the audience are also excited by this work. I think that what you have started as a project as two countries may end up as a project for many, many countries around the world, because you provide actually a prototype. You put down the marker in what one should be observing in the banking sector, around the country, especially in emerging economies and frontier emerging economies. Okay, so thank you very much. And let me, I can see some hands up already, actually. That's very good. Let's invite some discussion from the floor. I think the first hand up was Oladapo and the second Chess. So I follow that order. Okay, Oladapo. Yes, Oladapo is looking at banks globally and especially on a macroprudential. So this is in your own neck of the woods. Oladapo, please go ahead.
Yeah, good afternoon, everyone. Yeah, thank you very much for the presentation. It was quite insightful. And just like Victor mentioned, I think it's a paper that is inciting so many thoughts, and I think, like you rightly mentioned, I've been looking at macroprudential regulation in developing and emerging economies. And one thing that, an interesting theme that we find, in these countries is the fact that there's been instrumentalization of central banks, such that there is the weak central bank independence in this region is leading to financial instability in this region. So I like the way you connected the whole thing, and you connected it to the fact that the level of shocks that we are seeing in the two countries that you have looked at is kind of different. But for me, I think we also need to pay attention. But I don't know if it's something you looked at. I think we also need to pay attention to the supervision structures, banking supervision structures in these two countries. So what we've noticed is that for countries where, so now I'm talking about emerging and developing countries, for those countries where there's a supervision of the non-bank, there's a strong supervision over the non-bank financial institutions, you see that the shocks that pass through such countries are usually lower compared to countries where there is no strict supervision over the non-bank financial institutions. So I don't know if this was considered in your paper, or probably you can help share more light in regards to this in those two countries. Thank you.
Thank you very much, Oladapo. The banking supervision elements, I think, are very important. Maybe let's have a flow discussion, if that's okay, with you, Kerem, Dora, and Fulya. Maybe you can respond to Oladapo and you can the flow, and then link to before I call upon Chess. Is that okay, or do you want to correct the questions all around? Yeah, what do you prefer?
Maybe we can take one more question.
Okay, great. Okay, so Chess, please go ahead. I think you are muted. Okay.
Yeah, okay, now hopefully you can hear me.
Yes, indeed. Yeah, thank you.
Okay, great. Thank you so much for the presentation. It was really interesting, and I think the empirical detail here is quite remarkable. So my question, or I guess series of questions, is mostly focused on the theory and kind of how your argument relates to existing theory. So that when you began, I really thought this was a kind of contrasting context paper where you were going to emphasize the differences across, emphasize the similarities across Hungary and Turkey, right? And kind of use those cases to sort of show that there's been something missing in our understanding of what's happened in these two authoritarian countries. In other words, it's not just about these personalities, their violation of the rule of law, kind of authoritarian populism. Of course, that's there, but underpinning all of this is the larger structure of the transformation of capitalism. And so we can't simply say, if only Hungary and Turkey hadn't had these populist leaders, they wouldn't be in the situation. We need to think more deeply about the structure of neoliberalism and finance and all these things. So that's what I first thought, and tell me if that's wrong, as sort of, so in a way you're kind of pushing against the rule of law theory, right? Or kind of our predominant political science understanding of how these leaders come to, why they exist. You're saying, no, this actually is about structure. So tell me, that's what I got. But then as you moved further in, I realized actually this is as much a splitting paper about the differences between these countries as a similarity paper. And there it wasn't so clear to me what the real theory was. I mean, I understand that there are these differences of FDI versus different kinds of banking systems, but what's the theory of that? And how does that relate to our foundational theories in the field about different financial systems? I mean, so there it was a little bit unclear to me, and maybe I just don't know enough about the cases or what you were saying. But it would be helpful to know exactly what you're saying and how what you're saying is different from what other people are saying, just very simply. That's my first question. And the second question is basically, you did a good job showing the logic of these coalitions, right? That there is a logic, that it's not just the whim of these two men, right? That they actually are part of social coalitions, and that different parts of society benefit there. But if you're gonna do that analysis, I would like to hear more about kind of how sustainable is this? Where are there coalition breakdowns? Because we can always find people that benefit, but exactly, should we expect this to be a durable coalition, or is it because it's so focused on in a sense, putting on crisis, putting on a crisis, and then that leads to new crises which have to be put out. Is it actually quite a fragile coalition that we might expect to break down, right? Because, I mean, when you have 80% inflation, it's how long can these strategies last? Are they kind of delimited? Are they self-destructive in a way? So those are my two questions. Thank you so much.
Thank you, Chase. I think bringing up the theoretical underpinnings is helpful because we provide a framework for interpreting, the work. Do you want me to take up the third comment maybe, and then So let me take. Yes, there's a hand up back. Please go ahead.
Can you hear me?
Yes, we can hear you loud and clear. Very well, thank you.
The thing that I just want to ask is directly related to policy implementation of the Central Bank of Turkey right now. By the way, we call it Turkey because we has just changed the official name of Turkey to Turkey, and you can call it Turkey, and which is better for us. Apart from this one, I just want to make an emphasize on the policy implementation right now. Even if the Central Bank of Turkey is trying to increase the interest rate in Turkey, there is a negative real interest that we have in Turkey. And after the policies that the central banks has used in Turkey has worsened the economic condition in Turkey quite badly. The thing that I'm just going to is do you think that the Turkish economy can be in a good path if they just continue to increase the interest rates in the near future? And do you think it's just gonna alleviate the burden on the inflation? And apart from this one, if they continue to use this kind of increased implementation set, is just going to decrease the unemployment rate in Turkey also. The thing that I just want to learn from this, because on the presentation, as far as I can understand that, they just worsened the economic conditions. And right now there is a negative real interest, and the capital inflows, the foreign direct investment is not coming into Turkey also. So there is a threshold right now, which is directly related to economic conditions just like that. Unemployment rate is high and interest rate even is on the rise. They are just also negative interest rates, and they just decrease the investment in Turkey also. And as far as we know, the Fed, also the Bank of England, is not going to decrease the interest rate in the near future, maybe up to next fall. It is not certain, but most probably they are not just going to decrease the interest rate, which means Turkey is not going to get foreign investment from Western countries and also all around the world. Maybe it is not a certain thing, but it's just the most probabilistic idea, which is happening around the world. The thing I just want to learn, what is the exit? What is the strategy for Turkish economy will be for your expert opinions that I just want to learn from you. And by the way, I just want to thank for all of the speakers, and I just want to thank for your all efforts. And that's it.
Thank you very much. And yes, this is a very interesting question at the time when most central banks around the world are looking at inflationary pressures and raising interest rates. But what does it mean for Turkey? Now I can pronounce it much better. So maybe let's now go back to you, Dora, Fulya, and Kerem. In whichever order you want to go ahead and make observations on some of the comments made, and then we continue. So I'll come back to the audience. I can see a hand up. Christine, I'll come back to you if you don't mind. Let's first take the responses around, and then we continue the discussion.
Oh,
okay. Who's going fast? Yeah.
Okay, well, thank you very much for your comments and also for the questions. These are super helpful and also will help us restructure and revise the paper accordingly. I will start with the questions that I feel more comfortable with answering, and then leave the remaining questions to my colleagues for them to also engage with them. Maybe let me start with Oladapo's question about the instrumentalization of central banks. I think this is also very important, and we also see that in both cases they have effectively been captured by the incumbents. There's greater political meddling, both in the case of Turkey and Hungary, with respect to the monetary policy, and I think in that sense, political meddling paves the way to instrumentalization of the banking system in general in both contexts. So I think this is an important prerequisite in the sense that, you know, both central bank and also the banking regulator in Turkey are critical in terms of achieving the political objectives of the current political party at power. So I think we should probably highlight that a little bit more. So moving on to, does this also apply to all banks? What about investment banks, commercial or development banks? I think that's a really, really good question. We frankly did not look at in detail what the development banks in both contexts are doing. I can't really comment on that. I guess this is like private-public distinction is important. Domestic ownership versus international ownership is also important. And these are questions that we did not systematically examine in this current version of the paper. But effectively, we're looking at mostly universal banks. And we know that in Turkey, public ownership is pretty high. And therefore, that makes it relatively more convenient for the government to instrumentalize credit allocation through dictating the terms and conditions by way of telling the public banks what to do and what not to do. And we have seen several examples, like anecdotal evidence in the past shows that credit restructuring or loan repayment restructuring have been eased, especially for politically connected firms at times of hardship. So we know that public ownership matters, but I think it's a great question to also look at these different types of banks and how this actually works in other contexts as well. Moving on to the question on theory by Chase, I think this is a really, really important question. Now, our goal over here is basically the outcome is the same, right? If you think about Mill's methods of case selection, banks are instrumentalized in both contexts and under neoliberal authoritarian regime. So it's a method of agreement, so to speak. So in that sense, they're similar on the outcome. But what we're trying to highlight over here is the path to this outcome varies, and it's not basically a single line that applies universally across all cases. There are two critical variables over here. One is, as I mentioned in the presentation, how they're aggregated into the global financial networks. What is the primary mechanism through which economic growth happens in these contexts? Because they are basically both dependent on foreign capital, but the way that this foreign capital operates in both contexts is very different. One is primarily through FDI, the other one is mostly through portfolio inflows, and that creates even more instabilities, for instance. That's basically one important variable. And the second one that differs in both contexts is how the social bloc that supports the incumbent basically responds to these changes and crises. So they're instrumentalized differently in a way for political purposes, but how they're instrumentalized in one case, in the case of Hungary, it's primarily for ensuring continued household access to credit for consumption, for mortgage access. And in the case of Turkey, businesses basically are prioritized in our observation, mostly SMEs, and their funding needs. So I think these are important points to make. And the broader theoretical contribution that we would like to make is not, just making this distinction between FDI-driven or portfolio inflow-driven growth models, but rather to highlight the fact that these developmentalist states of the past are impossible to replicate under current conditions. I mean, we can't basically have another South Korea coming out of these contexts, for instance, because the structural constraints that basically affect the political economy calculus of these actors prevents them from coming up with these long-term developmentalist goals, defining and hitting these long-term political targets. So in a way, we're speaking to the Alice Amstons and maybe Dani Rodrigues, who basically say, well, state still has an important role to play in development. While we're saying, well, maybe it's no longer economic growth, it's effectively a political survival story here. And that's why we basically see these short-term planning, short-term calculations, negotiations. And this brings me to your second point about whether these coalitions are durable. We don't think that these are durable, and that's why we see increasing intervention on part of the incumbent and greater drift to consolidate authoritarian rule. Precisely because these coalitions are fragile, at least in the context of Turkey, that's the case. And I can basically give several examples with respect to how the internal fight within the political party led to the ousting of the internal critics and thereby narrowing the ruling coalitions. They are not really, strong coalitions. They are fragile coalitions, and therefore we basically see this constant push for or incentive for political survival. I guess we can maybe give further examples from Hungary, but I will leave that to Dora. And I will stop over here and leave the floor to my colleagues. Thank you.
Thank you very much, Fulya. Very, very insightful, especially that on fragile political coalitions. Okay, yes. Who coming? Kerem or Dora?
Maybe I come in and then we go back to Turkey,
Please go ahead.
if you don't mind. So thank you so much for the very interesting and insightful questions. So starting with Victor, I really appreciate your insights into the diversity of banking, right? Loans and security, as you mentioned, could be or government or private sector, or government sector and private sector. But I think what we see in emerging markets is this sad simplicity of banking that also enables the takeover and instrumentalization of banking, right? The capital markets in both countries are very small. Bank dominates financial intermediations. So securitization is not an option. It's not something that banks do. The public sector, in terms of publicly owned corporations, again, in the thoroughly privatized Hungary, is very small. So the lending is primarily to the private sector. So I was thinking about your insights about the variety of finance and banking that we see in core countries, how that is missing in the periphery or semi-periphery, enables certain processes that are not there in the core, but much more easily detectable in the periphery or in the semi-periphery. To Oladipo, the question about banking supervision, I think that's a very important question. And although in the presentation I didn't talk much about it, but certainly up until the 2008 financial crisis, the weak supervisory structures definitely enabled how the global financial crisis hit the Hungarian banks, so the banking sector and then households and SMEs. So this irresponsible FX lending that did not take the risk inherent in FX lending into consideration was something that supervisors have seen and they approved, and they were not very critical of these banking practices. Now, this is, of course, going on in the larger context within which the Hungarian government has to withdraw due to EU austerity measures from welfare provisioning, and then and then allows Hungarian households to substitute basically welfare provisions coming from the government by private loans. Right. So, and then the price they pay is that, of course, then nobody has to show income, in proofs of income, right? So very risky lending is approved by the government, but this is done within this larger structure of European governance of austerity. And this brings me to answer Chay's fantastic questions, right, about the theory. And obviously we would like to say something as we started out, a combination of IPE and CPE research about the nature of global capitalism. And I think what we see in both cases is that there is a neoliberal enabling of authoritarian instrumentalization of banking, right? The previously and globally compatible neoliberal regulatory structures enables the authoritarian leaders to come into power and instrumentalize the bank. But at the same time, we also see a neoliberal constraining on the chosen policies, which precludes long-term developmental goals to be pursued by these authoritarian leaders. So in this sense, I think, so this process we see in both cases, right? And then what we presented you was this very detailed bits and pieces of how they differ due to their different historical trajectories and due to their different banking and financial structures. So I think this is it. And I have a question to Victor, because I think that was very, very interesting. So you mentioned something about Basel III and how that is implemented in these countries. And I know for the case of Hungary is that Basel III is thoroughly implemented because it became a European Union directive, the CRD, which all member states, not just Eurozone member states, but also non-Eurozone member states like Hungary, were required to implement. And you mentioned that you see there is a way in which Basel III implementation enables instrumentalization of banking sector. And I'm really curious what you think, how this mechanism would unfold.
Yeah, that's interesting, Dora, and thanks for engaging on the conversation. I think that the way banks are supervised or regulated in terms of the global templates of Basel III will enable to what extent they can be political capture, or to what extent the banks are constrained either in lending or in buying securities. The Basel III introduced this important component of what assets, what market assets we can go for, and the ability of being able to for the banks, for example, to be able to take on board treasury bills, both from the government, but also government bonds from other agencies. And I think that this is where the difference can be, because if the banks are completely able to do that, it's actually now a global trend whereby banks have a choice with their resources. They can do lending that create assets held by private companies, in which case they may lend and maybe they expect that there will be a failure of about 12% of the projects, and they price the loans taking into account the probability of failure of some projects. So they integrate that into their loans, and therefore the interest rate goes up, because they expect that on overall they're going to capture or even be able to recover some of that money, even if some projects collapse. But they have another alternative. They could instead increasingly push all their funds into buying treasury bills from the home government or from the rest of the world. They go around. They go around in New York, London, and so forth, on road shows, selling. But they buy some of those securities, because especially if the securities are guaranteed by central banks or are guaranteed by stable government. So in a way, the return is low, but the risk is almost zero. Okay, and the government can take advantage of that by actually selling off almost all the debt to be held by commercial banks. So you could have a country in which thereby, right, the debt is being bought by the commercial banks. Now, that is immediately crowding out the private sector. It's crowding out it's crowding out all the private businesses that will be able to get it. And it's an increasing tendency, actually. This is why I was thinking that if you had the data, that data, by the way, should be publicly available. You can actually have the evolution from 2000 to the present and showing the way banks have now in the two countries where they have actually migrated, reduced the loans power to private sector and instead increased the liabilities. The formula is a simple one: D plus E equals L plus S. And you see whether L is shrinking and the S is going up. And you know then, of course, that because of the introduction of Basel, countries are able to do that. And yes, there has been some consolidation away from the private sector.
Well,
Okay,
this is super interesting. Thank you so much. Because we both see in both countries, right, public debt portfolio of commercial banks going up, but we were both assigning it to the authoritarian leaders instrumentalizing the banks. But I think it's a very interesting observation that there is a global context to it, right? The global governance context within which this is done, and it's actually enabling this. So thank you so much. This is very interesting.
Yes, indeed. Thank you, because it's a big departure from the standard capital adequacy ratio of 8%. It's the way in which now you are actually taking, even for those who are able to settle the debt, using futures to be paid at a later date. Then of course those can even take on more what used to be called or has been called, referred to as a toxic financial instruments. Let's see whether, do you want to come in, Kerem, or shall we go around for another round?
Yeah, I do not want to take too much time of yours. I would just, like to just like a note. So when it comes to securities and loans, so through like the Basel regulations, so those treasury bills are not just, like free to invest in. So they're actually, subject to ratings. So once the Turkish bonds are just considered as not like under the investing levels, so then this increases, the cost of even investing in government bonds. So imagine, the government loses that investment quality, but it's still forces its banks to still invest in government bonds. So which increases the cost of lending. But this might not be in the case of Hungary, which also follows EU rules. I just want to show. Sorry. So this is the ICAP, for example. So as you mentioned, currently Turkey is not, so EU rules are followed by EU countries plus Hungary. So it looks more in terms of it's greens. It's more more compliant, while Turkey is not compliant in the several settings. But it was, for example, when I was doing my own PhD study, I was a bit amazed how Turkey was fully compliant with most of the Basel III compared to the other countries as well. So it actually implemented a comply, but according to my own the field research as well, so Turkish regulators generally follow those deadlines and those cycles, but currently it is not following, probably because of this nationalist responses of, BCBS rules are just a foreign agents or just foreign actors imposing external rules. Second, even the agenda probably is not following it. Third, I was hearing from anecdotal notes. The central bank governor was not even attending the meetings in Basel, the previous one. And then even, the regulator lost much of its human resources. So, some technical stuff is also gone. So how can you also follow up with these foreign meetings and regulations, etc.? When it comes to the diversity of banks, so this is so why we, concentrate on the deposit sector. So deposit banks, including private and foreign, and also public banks. So this is, how like minuscule, or even like negligible when it comes to say SME lending in Turkey. So as we see, deposit banks are like providing the more than 2 billion more than 2 trillion Turkish liras compared to 130 billion liras provided by development and investment banks. So this is why SMEs rely on deposit banks. And on the other hand, this is the balance sheet of investment banks, which is a bit like compared to, like they're almost like nothing. I'm not saying like just like ignoring, but like deposit banks are like more than 18 trillion liras, while it is very like less than like 1 trillion liras in terms of development and investment banks. So this is the so this is just some like statistical like the background like motivations. So why we are just looking at those deposit commercial like retail banks, because they constitute, so they are the center of the banking sector and therefore the financial sector. And then Fulya and Dora replied, like respond, like Chase's questions. Thanks very much. And I just like just don't want to take more time, but just mention that this interest rate hike in the like a current spell is just to me it's just then like a receive like to generate capital inflows, but it cannot until now, and then the government is also a bit probably struggling with and also trying to find out probably like what to do and then like how to bring in foreign capital. The economic conditions have worsened and they'll continue as such in the future too. So I stop here.
Thank you very much. Thank you. Let me get back to the audience and see if there is a pressing question. I think our colleague Christine had to leave for teaching. We'll feed the comment back to Kerem directly. Any comments, observations? Am I missing some? Let me see. Let me put on the full. Okay. There is one small point, and I'm asking this on behalf of Jeffrey Igodosa. Jeffrey has done some excellent work on credit information sharing systems. These are important for, of course, all the banks in a single economy, and also for the private sector, and also for the central bank. Jeffrey has data on credit information sharing systems around the world, distinguishing between credit registry and credit bureaus. One being the compulsory information. Every commercial bank has to submit information on who is lending and who is not repaying the credit information. And the other is voluntary. Now, you see, the argument here would be that the instrumentalization of banks for political consolidation may become a little bit difficult or be difficult to achieve, or may not go smooth if both systems of credit information sharing system exist. Because public information will be out there in the public domain in terms of how much a government is borrowing, how much the politically connected firms are borrowing, and maybe government connected firms are not repaying. So the information would be there in the public domain. So I'm trying to see whether it's possible to argue that the basis of credit credit asymmetries, credit transparency, credit information asymmetries, reducing the asymmetry on credit information, may be one way in which we can be able to get more insight in both Hungary and Turkey in that. Would that be a plausible argument? I ask this to Jeffrey and also to Kerem, Fulya, and Dora. Yes, please go ahead.
Can I just, okay, so in Turkey, there's a very, very good data collection and data dissemination. Even at a daily basis, you can follow the banking sector's balance sheets on the bank regulator's website. Second, there's a very, developed like advanced credit registry, which banks can also, like, see each other's screens, and even like on my domestic bank mobile app, I can add my like other bank accounts and sorry, and my primary like bank can even observe what I'm doing with my other bank accounts. So when I allow it, so even banks can even monitor their customers and their additional bank accounts within the whole financial sector. So when it comes to also, defaults, these are also, visible again, and also there is public information statistics. I will again share my screen, and
Oh, yeah.
this is the framework agreement in Turkey, for example, to restructure those like the loans, especially borrowed through the credit guarantee fund. So it was actually around, like more than 5 billion liras, which lead to even in total since 2019, it is now like more than 200 billion US dollars. And as you see, so this data is also available on the Banks Association's website. So you can actually just download the statistical reports. So there is not like data asymmetry. Even I can, as an ordinary citizen, can observe even the size of, credit, like defaults, even restructuring. And once those are covered on the news, especially those like cronies or like AKP Erdogan supporters, as we need to highlight, I think that in my a part in the revision, which I will highlight. Those are coalition partners. Structured like more than billions of dollars in the last couple of years. So I could not say there is data asymmetry, even very a public, even in this authoritarian context, data is there. So they actually do not disclose the data they do not want to be seen, but these are not within this filter. So it is very selective case of yep.
Yeah. Thank you, Kerem.
Yeah. So in Hungary, it's not the case. It's similar in Turkey in the sense of the credit registry registers both positive and negative lists, and it's publicly available. But the reason why we still don't know why, the rate in which Orban allies are becoming wealthier, is not because the banks would not, register the data. It's because there is this tendency for Orban allies to create private wealth funds, and through this new legal, framework, they are able to hide their personality. So the bank data is there, but who is exactly owning and who is behind these private wealth funds is what is actually obscuring public access to these people and their wealth.
Thank you very much, both Mehmet and Dora. Jeffrey, do you have something to add to this? Is Jeffrey with us? No. Okay, so in general, I think let me maybe give you 1 minute if you have something final to say, and then I will thank you and we'll round up the seminar. Oh, we are only remaining with about 8 minutes. So maybe 1 minute for you to give a closing statement. Who would like to do so?
Yeah, thanks very
Okay.
much, Victor, and all colleagues about for their comments, suggestions, interventions. I think, yeah, you also enjoyed it. I think we enjoyed it very much. Thanks very much for the opportunity. And yeah, meeting you all virtually. But yeah, thanks a lot for the for the slot and the opportunity.
Oh, thank you too. Definitely, this is a very exciting, fundamental piece of work, and I like many things about the work, as I mentioned earlier. It's exciting to see the political economy angle and introducing a multidisciplinary element in terms of the way we understand the functioning of banks. I think that you have laid the very good marker as part of this study for possible extensions of the work and looking at what the developments in the banking systems, especially in frontier emerging markets. So we thank you very much, and we hope that this work will benefit from this meeting, the discussion, the fact of thinking about it, presentation, the discourse, ways of extension, and maybe some of us will join you in a project to extend this work and look at economies, because that evolution of the banking sector across the world has been of interest. But some especially economists and finance specialists tend to assume that it is only the banking sector per se. They tend to ignore that kind of political economy dimension, which is absolutely interesting because banks don't work in a vacuum. They work in an environment, in an ecosystem that constrains what they do. So thank you very much. Please joining me in giving a hand of applause to Dora, Fulya, and Kerem for this wonderful presentation. Let me also take this pleasure to thank all of you who have been able to make it to this meeting, to share with us this seminar. And I look forward to seeing you again next week, same time, for another exciting seminar. Thank you very much. Thank you.
Thank you.
Thank you.
Thank you and goodbye.